gives three messages. One is that there has been an acceleration of integration of developing and emerging economies into the global financial system in the new millennium. And this is not only deepened, but its pattern also has changed. Second message is that the old vulnerabilities to international financial shock remain largely unabated, but we have, in addition, new channels of transmission of international financial shocks. And third message is all emerging economies are vulnerable one way or another, and there is no room for complacency. The integration process, I look through the external balance sheet. The external balance sheets, gross assets and liabilities, are quite important in analyzing external fragility and vulnerability. Rather than focusing on the net balances, because we know that countries with positive net balances, whether in international investment position, even current account position, can become illiquid. So we need to pay attention to the leverage and structure of balance sheets. External assets and liabilities do not belong to the same people. They do not have the same structure with respect to currency composition, or instrument composition, or maturity, or liquidity. So we need to focus on the structure and leverage of the balance sheet. Now, what we see in the new millennium is a rapid integration in the sense of expansion of this balance sheet. This expansion actually took place more on the asset side because collectively these countries run current account surpluses. But nevertheless, a large majority of developing countries accumulated assets from liabilities. That is from capital inflows, because they run current account deficits throughout the millennium, except a few countries like China and Russia. The third boom in international capital flows, the inflows that started in the early years of the new millennium, was very important in this integration. You can see that, and this boom was far above the previous boom of the 1990s or the first boom of the 70s, 80s. And this boom resulted in a significant expansion of assets and liabilities. You can see that net inflows by non-residents have never been negative since the 80s for emerging economies taken together. That means that their liabilities have been constantly increasing, even though net inflows have been highly volatile, and in fact, from time to time, they became negative, as we saw it in 2015 and 16. Now, basically, two factors played in this rapid integration. One is the monetary policy in the United States. The Fed used progressive loose monetary policy in the United States, in the sense that it cut interest rates more and more during downturns, but it did not raise them more, or it raised them less and less during upturns. This introduced a bias, downward bias to the to the real and nominal interest rate, and also an upward bias in debt. The blue area is the debt ratio to GDP in G7 economies. I will say that we have a similar situation in the South. And this process also led to a search for yield in high return and high risk assets, and particularly in the emerging markets. And this factor, progressively loose monetary policy in the US, has been an important factor in the integration. The second reason is the liberalization in emerging and developing countries themselves. These countries, after a number of recurrent crises in the late 90s and early 80s, rapidly liberalized their capital account. And sometimes this liberalization took place in order to avoid the problems they had faced in the 1990s. I'll explain what they are. And I argue that these measures perhaps would have been quite useful in preventing the last crisis, but they then may not be adequate to prevent the next crisis, given the change in the pattern of integration, and they may even be the source of new instability. They did 5 things. First, they tried to shift from external debt to equity on grounds that equity is more stable and less risky. So they opened equity markets to foreigners and liberalized foreign direct investment regimes. Second, they tried to get rid of this so-called original sin problem by opening their bond markets to foreigners, is already being mentioned, and borrowing in local currency. Third, they opened capital account for residents to invest abroad. This actually took for several different reasons. One important reason, the former governor already explained that in his book, to avoid intervention costs. There was a flooding, foreign exchange, a glut in the market. There was intervention cost, and at the end, they decided that they
average spread in these bonds that people take advantage of. Maybe are they really cheaper by some percentage points or otherwise? Like normally, if I am able to borrow at say 7% for funding the normal fiscal deficit for government, and because you were saying that since money is fungible and it can be misused for other purposes, so are they really cheap? Means by say at least 100-200 basis point from their normal cost of borrowing. So can you please elaborate?
Kind of a question. The issue of the externalization or internationalization of domestic debt. I do not appear to have a very clear distinction where we stand today, because just like Mr. Akyuz has indicated, for some countries it's about 40% holdings, foreign holdings of domestic debt, and for some countries it's much higher than that. So the line between where external debt stops and where domestic debt stops becomes completely obliterated. So you really don't know what is domestic debt and what is foreign, because when the liabilities become contingent anyway, you have to pay it in foreign currency, especially in a situation where you have a huge portion of the domestic debt being taken up by either foreign portfolio investors or that kind of a thing. So so maybe Mr. Marcelo did mention that issue also. I don't know, what was the thinking of the World Bank around this? How do developing countries, essentially who are in need of funds, try to navigate between domestic debt and external debt now that the lines are becoming not too clear? And then maybe just one other issue is on infrastructure finance, which was mentioned by Mr. Masiro. For a number of countries, there's a huge chunk of existing funds, which is held up in pension funds. But how to leverage existing huge reservoir domestic pension funds to finance infrastructure is increasingly becoming a problem. For my country, for instance, we have over $30 billion in pension funds. But apart from issues of legislation, how do you realize the investment over time and ensure that the pensioners are not worse off? Maybe I'll just restrict my questions to this intervention.
Thank you. We'll take one more from Ghana, and then we'll give the opportunity, if we have more time, then we'll take questions. Please brief on your questions.
Yes, thank you, Mr. Chairman. I have two brief questions. It's not maybe an explanation. Regarding general borrowing, we know borrowing are supposed to be for developmental issues. I know some countries are still running some IMF program, and in your presentation you made mention of borrowing that are, for instance, for green bonds, are not used for green bonds, but for budget support. I want to know how IMF is supporting those countries to ensure that borrowings that are done are used for the purposes for which they are borrowed. I think in the last presentation, some policy responses to how to manage shocks. You made mention of temporary standstill and exchange control. I want to know countries that are currently using a flexible exchange rate. How do you implement exchange control? By which means? Thank you very much.
Thank you. Please.
Behind the questions there are implicit statements, and I find myself in agreement with the statements. So rather than answering, let me try to build on your statements and think together about these issues. The first question about our colleagues in India are branded bonds. That's the word we use, branded, because there is a brand. You know, the brand is a mental association, which may or may not be there. So when we say green bonds, or blue bonds, or sukuk bonds, are they cheaper? Not necessarily. Okay. We have seen both cheaper and we have seen more expensive. For us, for the World Bank, tends to be cheaper because our investor base is already so diversified that we can pick the one investor that's willing to pay a little bit more for our bonds just to have them green. But a certain single sovereign comes out and says this money will be for green purposes. The market may or may not value that promise in itself. So it may be that these bonds are as expensive as the normal general purpose bond. What makes it even more expensive, and this is where our internal debate is, and we will publish a paper soon on how these branded bonds are doing, both from the point of view of price and the point of view of certification. But what may make it even more expensive is the cost of producing the bond. Because you have to have a system to show in the documentation of the bond that you are going to be doing a certain thing. And sometimes that certain things require certification. You have to certify when a bond is Islamic. You don't just say it. You have to have an institution in your country. Take Malaysia with the green sukuk that they issue. You know, it has to be an Islamic institution in the country that says, well, let me look at the terms of these bonds and I will tell you whether it's sukuk or not. So that has a cost. And at the end of the day, the all-in may be more expensive than just a general purpose bond. Will that mean the end of this? Probably not. Because it's a great tool for diversification of your investor base. So I don't think you do this for cheapness, you do this for variety. That's my pride. But hopefully we'll come out with a paper on this soon with our experience. It's 10 years of experience. And we started this business in 2008. It was the bank that issued the first one. 2008, the first green bond. And we already have 135 of our own bonds being green and sold. But we are not the real comparator because by definition we are AAA plus and we're super safe. So for us it may be cheaper, but it may not be cheaper for Indonesia. It may not be cheaper for, say, India. So we are going to come out with some information and we promise to share it through Marilu or company to give it to all. But do keep in mind, you don't do this for the price, you do this for the diversification. On the question from our colleague from Nigeria, the line between what is international debt and what is domestic debt, very true, very, very true. And many of these local currency debts are actually sold to non-resident nationals. Diaspora bonds do that. You place local currency bonds with your nationals that don't happen to be in your country. Now, the contingent liability part, though, is almost always, foreign currency carried. I don't imagine that short of the pension system, the contingent liabilities that we are seeing now, which are mostly for investors coming into infrastructure, will be in local currency. Those investors normally will want to get their money in foreign currency or at least access to foreign currency. So your point is very well taken. You may see a guarantee for the toll road in Mexican pesos, but investors, the moment they get the pesos, they will want to get out of the country, and at that time they hit the exchange rate. So effectively, it's a foreign currency risk for the country, may not be for the project. So you spoke about the line being blurred, not being very clear. I completely agree with you. Which makes our life as public debt managers even more complicated. Now, on the question of infrastructure, how do you bring pension funds beyond the legal matter of allowing them to put money in these kind of infrastructure projects? They tend to look for long-term infrastructure projects. I think the cutting-edge problem is less to fix the laws and regulations, or even to attract these pension funds, because they want to diversify, they want to have a tail end on infrastructure, particularly in emerging markets that are promising. India is a case in point. It's a long queue of international investment houses waiting to go into infrastructure in India. Even as financiers of state-owned enterprises, I have power grid in my mind. And I know exact investors that are waiting with their cash at hand. What I think defines the entry or not entry is that these pension funds do not want to be in the greenfield period of the projects. Nobody wants to deal with environmental protection, eminent domain, social sustainability. Nobody wants to be at the construction time, the first 5 or 6 years of the project. Everybody wants to be in the brownfield part. So once a project has been constructed and is working, then they come on financing. To the point that now we are thinking about mini payments, meaning loans that are just for 4 or 5 years to finance the construction, knowing that then the private sector, the pension funds, and equivalent will come in and pick it up. For foreign in particular, but I would say for domestic as well, pension fund, to be explaining to its own board the riskiness, technical riskiness of the project, and the reputational implications if the project goes bad, they just say, no, I don't want to touch it. So the big task for us as emerging markets, not necessarily for debt managers, but at least for the managers to be conscious of, the big task is the preparation and execution of the project itself, the green field. And then the brownfield, there is plenty of demand for that. We are actually working with the Canadian pension funds, which are huge, because they are very interested in putting, particularly in South Asia, money in brownfield infrastructure. And then there was a final question which came from our colleagues in Ghana. How do we know that the money is used for the purposes they were reporting? I couldn't agree more with it. I'm an old fiscal hand, and fiscal people immediately see this. They say, yeah, you bring me money from a general purpose bond, and you bring me money from a green bond, and all the money goes what we call under the line, meaning it's for financing. Whether that money funds specific project that goes to the environment, or even whether that project already had funding, and I bring more funding that I call green, and therefore I release the previous funding to do something else. That we don't know, we don't control it. That's why we call it branded bonds. There is no direct one-to-one link. And I'm going to make an institutional confession. When we issue our gender bond, it's going to fund gender projects. But if you had asked me had the gender bond failed, would you not do those projects? The answer is no, we'll do the projects anyway. So when somebody comes to fund our existing gender projects, they may be funding effectively something else. Number one. And number two, even if they were to link additional projects to the new money, you still don't know whether the project is good enough. Because the documents don't deal with the project. It doesn't say this is for a project that will do A, B, C, and D, and these are the monitoring systems, and this is the impact evaluation. That's a different science. That's a very difficult one. When you do randomized control trials to see whether the impact is good or not, all that discussion is outside the documentation of the bond. So your point is very well taken. This is a brand. I'm going back to the India point. We do it. If we can get cheaper, we get cheaper. But we do it mostly for diversification of investment. And also, frankly, for good PR by the countries in question. The country wants to show leadership in the environment, and green bonds are good for the environment.
Thank you. Do you want to comment?
Just the holding of domestic issue debt. It doesn't matter, so you pay domestic currency. Now we know that U.S. is traditionally worried about U.S. treasuries being held by China and Japan and very vulnerable. But we never heard Japan being worried about that, even though Japanese sovereign indebtedness is much higher than U.S. sovereign indebtedness. The difference is that Japanese sovereign debt is domestically issued and domestically held. During the European crisis, some people asked, how come Italy and Belgium didn't get into trouble, even though sovereign debt in these countries were much higher than countries like Spain and others? And again, the answer was the same. They were domestically held debt. So external debt, I think the bank has a paper on it, the greater the proportion of total debt is held externally, the more vulnerable. Now, the one important difference is that you cannot tax foreigners. You can tax residents. If you start taxing foreigners, it is default, because you tax on the value of the bond they're holding. And that is a lot of difference in the behavior of the bond holders. Even though domestically issued debt is subject to domestic jurisdiction, the number of countries have BITs, which effectively eliminate this provision and prohibit such countries from using domestic bankruptcy procedures to deal with the debt held by non-residents. So there is a difference, and we know the difference in practice. On the exchange controls, it's being used quite a lot more than people believe. In the 60s, US used it, Switzerland used it in the 70s. More recently, Malaysia used it, Mahathir, effectively preventing third capital transfers through the banking system, because banks are always involved. Iceland used during the European crisis, and I have a long discussion about the Icelandic approach to the resolution of the crisis in my book. Spain used. So these are not secret things. There are procedures, there are measures to do it, and the problem with that is if you don't have a proper regulated system in place, okay, and capabilities in the bureaucracy, there'll be a lot of leakage, the capital flight. In 1994, again, a G-24 meeting in Cartagena on the occasion of the 50th anniversary of the Bretton Woods institution. We had it with UNCTAD, G-24, and I asked a governor, I think it was governor of Colombia, I said how they were imposing certain types of control, market-friendly controls on inflows. And he said, we succeed 70%, and that's good enough for me. I think the point is that if you're desperate, countries don't take this lightly. Countries do not take lightly the control of outflows. That's the last thing they do. And when we promoted this International Chapter 11, we made that point. We don't think this is going to be used every day. Okay? Because, I mean, I've seen in the interim committee, many countries, developing countries, were not keen on that kind of debt resolution. For the simple reason that they thought that would undermine their return to the bank and the international market. So I think you can use controls, but as a last resort. The point I'm making is that countries will not be able to use it because there is no institutional arrangement to protect them against litigation and creditor action in such cases. Okay? We don't have this. IMF in the past said we can lend into areas, and that way we can show that we are favorable to these controls, but effectively it doesn't really protect against litigation.
Yeah, thank you. I think last question, Algeria was keen, and also Governor.
My name is Akyuz. I'm Deputy Director within the Ministry of Finance of Algeria. I thank the presenters, the speakers for those presentations, very informative and very insightful. I have one question regarding the Algeria's case. As some of you may know, Algeria is one exporter of oil and gas products. And Algeria also decided in 2005 not to resort to external debt anymore. So the question is, how did Algeria finance all its huge development programs since that time? And the answer is that it was exclusively financed by public savings that the government was able to accumulate during the period of greater financial situation resulting from the rise in oil price. So today, and after the fall in oil price in 2014, the Algerian economy has been resilient, and the impact on economic growth has not much been noticeable. But we still have, a good indicator, macroeconomic indicators, but Algeria returns to the normal situation, which is lack of resources, which is in economics the normal situation. And to cope with this situation, the government decided two major measures. The first one is to give the priority to domestic mobilization and resource, the mobilization of domestic resources, which remain important, especially in the informal sector. And for example, the government launched at the end of 2016 a bond issuance for a total amount of 500 billion dinars. And the second major decision which was taken by the government last September and adopted by the parliament, is to resort to unconventional financing, which is commonly known the quantitative easing for a transitional period of 3 to 5 years. So this decision allows the central bank to buy treasury notes to finance treasury deficit and productive investment. Of course, many experts criticize these measures because up to them it is likely to create an inflationary spiral by the debt monetization, but others think that it won't be the case because the M2 money supply is very lower comparing with the volume of the loans and foreign exchange also reserves. So I would like to have the view of experts on this matter, on the the unconventional financing, its limitations, its benefits, and the condition of its success. Thank you very much.
Sitting here, the thought that occurred to me was that the time is really right for architects, and that plumbers are not going to be enough. So on the one hand, the side stream issues that Marcelo spoke about, their magnitude is such. On the other hand, the amplification of risks that Yilmaz vividly demonstrated as a result of the deeper financial integration. Clearly, if you take all that together, business as usual is not going to be enough. We've been through a very benign period in terms of the global financial conditions, and clearly the tide is changing. We're moving to a more volatile world where all asset markets, fixed income, FX are all going to be more volatile than they were. And in such a situation, if one looks at the architecture of instruments currently available and the magnitude of the problems that are likely to be ahead of us, clearly there is a mismatch. And it's very timely, I think, Yilmaz's final slides, which talked about a global strategy. Some of that has been on the agenda for a long time. I think we need to kind of dust them off and look at them again. And the G-24 has I think, an important role to play in trying to shape that agenda, in trying to see whether the whole architecture can be strengthened to meet the challenges that are likely to come up in the future. Thank you.
Les trois premiers intervenants de cette matinée et les autres en début d'après-midi, c'est-à-dire après le déjeuner. Donc, pour ne pas perdre le temps, je vais appeler Monsieur Untitled Chapter.
Thank you very much. So first of all, let me start by saying thanks to the G-24. It's really a pleasure to be here representing the World Bank, but it's also a pleasure to be here given that I am a former government official. I worked for 12 years at the Ministry of Finance in Brazil, which is a member of the group, so it's also a pleasure to use this old hat of mine. So many thanks for the invitation. So our session is about liability management operations, and I will cover the liability management operations in the external markets, and my friend Budwan will complement me talking about the similar type of operations in the domestic markets, for which we have similar objectives, but also some important differences as well. So these are the topics that I want to share with you today, which are a little bit of the rationale for liability management, the most common types of liability management operations, the exchanges, the buybacks, and so. I want to talk briefly about the financial derivatives, which in a broader sense can be seen also as a type of liability management, and basically at the end connect that to a debt management strategy. So actually starting by the end, I guess the main message that I would share would be that first, liability management operations are a very useful tool for the debt manager to manage its risks, to achieve its desired composition of the portfolio, the desired risk of the portfolio. Second, that it includes financial derivatives, and this is a field where we, as emerging markets, frontier markets, we haven't done too much. Partially because the market is still limited for us, but it's still worth looking at what can be done. And third, that the use of liability management operations and the financial derivatives should be an integral part of the debt management strategy, that any use of such operations should be done in a strategic way. I probably have more slides than I should, so when I come to financial derivatives, I will skip a few slides and just use one country example to convey the main message that I wanted. Because I also want to share a little bit with you from a recent paper that we published with a colleague of mine, Antonio Velandia, about a recent trend of more emerging markets issuing in euros instead of the more traditional US dollar market. So the rationale for liability management operations, and I know that most of you are very familiar with that, it's basically to be an additional tool in the hands of the debt manager to achieve its cost risk preferences. So for example, let's say today I have some loans in Japanese yens, and I get to the conclusion, looking at my cost and risk, that I don't want exposure to Japanese yens. So I have basically two options. One, it's just use my regular issuance plan and just wait for these loans or these bonds to mature and then issue bonds in the currency that I want, let's say US dollar or euros. The problem with using only this option is that this may take a long time. I may have loans that will come due only in 30 years or 30-year bonds, for example. So with the liability management operations, what we can do is change such risk exposure right now. It could be through the use of swap, for example, swapping Japanese yens to euros or to US dollars, depending on my risk preferences, or it could be in a more traditional liability management operation, or where you can go and do a kind of prepayment, buyback of those bonds, and issue new bonds in a different currency. So it is very useful to manage the cost risks of the portfolio, but my second point there is it is particularly useful to manage refinancing risk. And when you see what most countries are doing in terms of liability management, most of them are doing that concerned with refinancing risk. Marcelo mentioned in his presentation about the fact that when countries issue Euro bonds or global bonds, for some countries, especially smaller economies, it can mean a huge refinancing risk, meaning you are issuing this $1 billion and one day in the future, this bond will come due and you will have to pay the full $1 billion in one single day. So there are two approaches. One, you can say, well, there's no problem because when it comes due, I just issue a new one, right? Well, it may be the case, it may be not. And Marcelo also mentioned the case of Uruguay and how conservative Uruguay is nowadays regarding refinancing risk. And there is this story more than 20 years ago when Uruguay issued its first international bonds. And again, Uruguay is a small economy compared to a 1 billion international bond, that they had this in mind. Let's say, well, it's not a big problem because there is a market for Uruguayan bonds. When this bond comes due, we just issue a new one. This bond was coming due actually in 2001, and a little before the maturity date, we had the Argentinian crisis. And suddenly, the market was closed for all emerging markets. It was closed for Brazil, it was closed for Uruguay. And so Uruguay came to a point where it saw, well, I cannot really access the market at this point. And it was a big issue. It almost led to a default. So it's interesting to mention that Uruguay is nowadays one of the most conservative countries in terms of managing refinancing risk. So another approach is, well, you may have these Euro bonds coming due in the short term. Instead of waiting for their maturities, so let's say I have big maturities of Euro bonds next year in 2020 and 2021. Instead of waiting for their maturity dates, what I can do today is buy back a bit of those maturities in such a way that when I get there in 1 or 2 or 3 years, instead of having this $1 billion maturing, I have only 500 or 300 or so. Or what I can also do is just to exchange these bonds. Instead of buying back, I can offer the market to exchange these bonds that are coming due in the very short term with bonds that will come due in another 10 years, for example. The difference that we will see with BUD1 is that we don't mention market development as an objective in the external markets, because the external markets are already developed. But you will see many issuers, many sovereign issuers, saying that they will use this type of liability management operations to increase the efficiency of their yield curve, meaning building better benchmarks that will be more liquid, and will have a better price reference. I bring here, and I will take the liberty to share a lot of the experience of my own country, basically because, as I mentioned before, I was working in the Brazilian Treasury for 12 years, and this was a period where I witnessed a lot of transformations in the Brazilian Debt Management Office, including in this particular subject of the use of liability management operations. If you can see this graph, and I know that it can be a little bit confusing, but it shows basically the outstanding bonds in the international markets. The blue bars are what we call the on the run, are the bonds that Brazil is issuing last year and this year. So basically the strategy is to keep only two benchmarks, a 10 and a 30-year bond, and all the other bonds are subject to a continuous buyback program. This buyback program in the very beginning had the specific objective of reducing refinancing risk, meaning taking out of the market bonds that would mature in the very short term. Nowadays, it has a broader objective of just taking the off-the-run bonds out of the curve and improving these two benchmarks. One interesting story, our colleague mentioned the Brady plan, and I remember around 2005, when we started looking at liability management operations in the Brazilian office, we still had a number of international bonds outstanding that came from this renegotiation, from the restructuring of Brazilian debt. And for example, there was one bond that came out of this negotiation that was outstanding in the market, which the bond was named IDU, which stood for interest due and unpaid. So you can imagine you as a sovereign having a bond in the market that is called interest due and unpaid. So it's not the best marketing for any issuer, right? So part of the strategy at that point was to take out all these old bonds that were linked to the restructuring process and replace them with new standard bonds. So the traditional operations are basically the buybacks, what we call in the international markets the tender offers, and the exchanges. And again, the idea is pretty easy, and many of you have done buybacks and exchanges in the external markets. And they are basically operations where in one you say, look, I'm willing to buy back those bonds, I am accepting offers, and I will buy back using cash. The second one is saying, well, I'm willing to accept old bonds, but instead of giving you cash, I'm giving you new bonds. Of course, the first one, the assumption behind the first one is that you have the cash, or you have just issued, and now you will have the proceeds to buy back. What's interesting about the exchanges, for example, is that they are not only of interest to the issuers, they can be very interesting to the investors as well. Why? Because at least part of the investors, they may have your bond, and they may want to keep the exposure to that particular kind of risk, to that country risk. So they know that this bond is coming due in a couple of months or in a couple of years, so they may want to exchange for new bonds and keep that exposure in their portfolios instead of waiting also for those bonds to mature and going to the markets to buy new ones, so incurring some kind of investment risk as well. I would like to briefly talk about some more recent approaches. One question that some countries have been asking themselves is whether you should do these buybacks as a public operation or if you should do it in the secondary markets. And we had this discussion in Brazil, and Brazil actually now has a program that instead of going to the market as a public operation in one day and saying, look, whoever has this bond, I'm willing to buy it today, give me your proposals. What we will do is go to the secondary markets and buy small amounts on a daily basis depending on the prices. On the one hand, you can argue that you may have cost savings by doing discrete operations in the secondary market, but on the other hand, this is an option that is not available for all emerging markets. Why? Because you need to have capacity installed. You need to have a dedicated team that is looking at those potential operations on a daily basis. Actually, in the World Bank, we have supported a few countries executing buyback programs on their behalf. So they will give us the mandate, and we will use the operational capacity of the bank to execute those transactions. There's also this type of recent liability management operation that I'm sure many of you know about it, which is called the accelerated switch tender offer. So a fancy name to say that this is a kind of interesting liability management operation. Marcelo briefly mentioned that, which consists of an issuance of a bond, a buyback, and an exchange, everything at the same time in one single day. It brings huge advantages in terms of price tensions that it may generate in favor of the issuer, but also the fact that you can create benchmarks and you can reduce your refinancing risk in one single operation. I have an illustration here. This is actually this is a real operation that Brazil did. Using this structure that is called the accelerated switch tender offer. I hope the scheme is not too confusing to understand. The operation has basically three legs, three parts. The first one here, the first one on the left, is a regular issuance. You issue the bonds, you accept cash, you're just issuing a new bond. At the same time, you have the second leg, which is called the book 2, where you're just buying back outstanding bonds in the market. You're just buying back them with cash. And there's a third leg where you are also accepting outstanding bonds in the market, but you are exchanging these bonds for the new bond that you were issuing in the first leg. What you can